Money market funds have become one of the most popular investments in Kenya, and now assets under management are almost hitting the 500 billion shillings mark. Yes, half a trillion shillings in money market funds. But still, even with the popularity of money market funds, most people are still getting the use cases of money market funds wrong. I can still see people who are using their money market funds for retirement planning. I can still see people who are using their money market funds for long-term investments. So before you put in any other shilling in your money market fund, I would like you to watch this video so that you can understand the best use case of your money market fund, what you should be using it for, and what you shouldn't be using your money market fund account for. So if you like financial literacy videos, if you like money and investing videos, do consider subscribing to my channel, as I'll be releasing more education videos that can help you make even more informed decisions. So let's get right into it. I would like us to start our discussion about money market funds today by first understanding the role of money market funds and what money market funds should be helping you achieve. So money market funds are just a better place to save your money rather than putting your money in a bank savings account or under your mattress. So if you're a beginner who's looking to understand what money market funds are, you can maybe first watch a video that I've done on an introduction to money market funds. So like I mentioned, money market funds are just a short-term place to preserve your cash. So they are purely for capital preservation. So money market funds usually track two things. Number one is what we call the interest rates. So I think this year we have seen the Central Bank of Kenya cutting down on interest rates. So even banks globally, like the Fed, the Bank of England, most central banks in the world have been cutting down interest rates this year. So what money market funds do is that they usually track those interest rates because the rate of return you can get from a money market fund is affected by those interest rates. So we are coming off from a high interest rate environment because if you look from 2022 all the way to 2024, central banks, more so the Central Bank of Kenya, it was hiking or maybe raising interest rates in Kenya. And that means that money market funds were able to fetch high returns because even bonds and T-bills and other underlying assets in a money market fund were also fetching higher returns. But now we are coming off from a high interest rate environment, now a low interest rate environment. And that's why we have seen the Central Bank of Kenya and other central banks in the world cutting interest rates. And now money market funds are not fetching the 15, 16, 17, 18% returns. Money market funds are now fetching 8, 9, 10, 11% in returns. So money market funds are affected by interest rates, and money market funds should be tracking interest rates. Then number two, money market funds should also be helping your savings to outcompete, maybe to outpace what we call inflation. So inflation is just the general increase in the price of goods and services. So money market funds should help you to maintain the purchasing power of your savings. So whenever the inflation rate is high, also the underlying assets in a money market fund, like the fixed deposits, the T-bills, the T-bonds, also tend to fetch higher returns. So even a money market fund will track the inflation rate and also fetch a higher return. The whole idea of a money market fund is just to track interest rates and to give your money or maybe your savings a better return than whatever the inflation rate in your country is. So that's why I usually say that maybe a money market fund is a better place to save your money rather than putting your money under your mattress because it's not getting any interest. And then number two, rather than putting your money in your bank savings account, you can put it in your money market fund because it is fetching you a higher interest rates. For most money market funds, they will compete. Maybe they will fetch a higher return than most savings accounts. Then again, nowadays people are moving away from fixed deposits because fixed deposits can give maybe a slightly higher return, but then again, they don't give you the flexibility to access your money. But now a money market fund can give you both. It gives you a higher return and then you can still access your money within 1 to 3 days of asking. So that's why money market funds have become so popular. The best use case for a money market fund is for short-term parking of cash. So short-term preservation of capital. So no any long-term incentives, just short-term purposes, maybe short-term incentives that should be using your money market for. And which are these short-term purposes, maybe short-term reasons that should be using your money market fund for? So number one is to save for your emergency fund. So usually define an emergency fund as a pool of savings that can take you for 6 months in case you lost your job or you went without any source of income. So just like your fallback plan in case things went south, it can help you transition from one job to the other. It can help you now get into investments because in case you got into financial emergencies, you don't have to sell your investments. You can just use your emergency funds to get out of that emergency. Then it's also a good place because in case you have any financial emergencies, you don't have to take a loan, you can just use those savings. So an emergency fund is one of the very critical steps whenever you're talking about investing, because before investing, you must have the basics right. And one of the basics we really recommend is having at least 6 months of your normal savings saved in an emergency fund. And one of the best places to keep that emergency fund is in your money market fund account. So why is it that a money market fund account is a very good place to store your emergency fund? So number one, just the reasons that I have explained. It earns a very good interest rate that keeps up with the inflation rate. Then number two, you can easily access your savings because within a day or two of asking for most money market funds, you'll have your money in your bank account. Then number three, a money market fund is very secure. You can hardly lose your money in a money market fund because money market funds invest in low risk avenues. You can only lose your money if a money market fund is mismanaged. So that's what makes a money market fund a very good place to store your emergency fund. Then number two, the second best use case for your money market fund is using it to stack up your sinking fund. So what is a sinking fund? So a sinking fund is just a place whereby you try to anticipate any short-term upcoming expenses and then you try to save up for them. So for example, let's say you're planning to go for holiday in December or maybe next year. You're planning to pay school fees, you're planning to do a wedding, you're planning to go on vacation, you're planning to pay school fees. You can always save up for these things early in advance, so that maybe whenever that time comes, you have an easy time. You don't have to stretch your budget, and you can easily meet those expenses. Use case for money market fund, you can use your money market fund for entry into other bigger investments. So you can save up your money for a money market fund, so that maybe once you hit a certain target, then you can push that money to any other bigger investment. So let's say, for example, you want to buy a bond and maybe you want to invest a minimum of 1 million shillings in a bond, so that maybe you can get a substantial interest rather than just investing 50,000 or 100,000. So you can be saving up your money in a money market fund. Then once you hit your 1 million or 2 million or 5 million or whatever your target is, withdraw your money and now invest it in the bond or whatever asset class that you wanted to invest your money in. Then the last purpose of a money market fund is to use it as the cash or the liquid portion of your investments. So we all know that it's always very important to have cash with you, also as a serious investor, because you want to have cash that you can use to jump onto any exciting opportunities that present themselves in the market. So let's say, for example, there's a company that you really like, that you really follow. You may get a chance to enter into that position because maybe the price can have a pullback, maybe it can fall in price based on some reasons. So you can always have cash to jump onto such an opportunity. Maybe the CBK can float a very exciting bond that you want to jump into. Maybe the price of Bitcoin can fall to a very good level that you consider a very good entry point. Then you can always jump into that opportunity. So you can use your money market fund as a liquid or maybe the cash portion of your portfolio, so that you can use that cash to jump into any exciting opportunities that present themselves. So ideally, those are the best 4 use cases of your money market fund. So for your emergency fund, for your sinking fund, for entering into bigger investments, and then the last one being for the cash portion of your portfolio. Now, I want us to understand what you shouldn't be using your money market fund account for, because at the beginning of this video, I said that people still don't understand one of the things that you shouldn't be using your money market fund for. So I mentioned that you shouldn't be using your money market fund for long-term investments. So long-term, I mean anything more than maybe 1 year, 2 years. So anything more than 5, 10, 15 years. So those ambitious goals of maybe financial freedom, retirement planning, those long-term goals, you shouldn't be saving for them or investing for them in your money market fund account. And then number two, I mentioned that maybe a money market fund account is not the best place to plan for retirement. So I want us to understand why you shouldn't be using your money market fund for long-term investments, because all these things that I mentioned that maybe are not suitable for your money market fund, they all have one thing in common. They all have a long-term horizon. Why is a money market fund not suitable for long-term investments? So number one is the return rates. So like I mentioned, money market funds usually track the inflation rate and the interest rates environment. So whenever those things are high, returns of money market funds are going to be high. Like you have seen last year, in the beginning of this year, whereby money market funds went for as high as 18%. But in a low interest rate environment, those rates usually come down to maybe anywhere between 6 to 10%. Though that fluctuation in interest rates, and more so in a low interest rate environment whereby your money market fund is giving you 6 to 10%, is not a very good interest rate return, because other assets can compound at a higher rate than that. So maybe the T-bonds can give you 12 to 14%. Special funds can give you a 7 to 20%. Individual stocks can give you way higher than that, depending on the stocks that you select, or maybe your portfolio picking skills. So all these assets can give you a better return than maybe what money market funds can give you. So one of the reasons that why a money market fund is not a good place to invest your money is the return. So your money is only compounding at 5 or 6, 7%. per annum, it can compound at a higher rate than that in other asset classes. So that's number one. And then number two is the diversification. So a money market fund isn't as diversified because it doesn't give you exposure to different asset classes that have low correlation. So whenever you're trying to invest for the long term, you should try to build a well-balanced portfolio that gives you exposure to different asset classes. So for example, have stocks to have exposure to the equities market, have bonds to get exposure to the fixed income securities, maybe diversify with some offshore investments, maybe some Bitcoin, some gold, and other such investments in a well-diversified portfolio. So rather than having or maybe using a money market fund for long-term investment, you should replace that with a well-balanced portfolio. It gives you more diversification to take advantage of opportunities in any market downturn, or maybe in any market outlook that we anticipate where markets are going to go for the near to long term. Then number three, money market funds don't protect you from some risks, because for example, if you're only investing in a Kenyan shilling money market fund, you don't have protection from the currency risks, for example. So I've always shared this chart whereby 10 years ago, 1 USD was exchanging at 86 shillings. Today, 1 USD is exchanging at around 129 on that shillings. In nearly 10 years, our Kenyan shilling has lost value to the USD by almost 50%. So what about in 20-30 years? So our Kenyan shilling isn't as stable, or maybe it isn't as superior as the US dollar. That's why maybe you should always hedge your portfolio against currency risk by diversifying, or maybe having some of your assets held in a stronger currency like the USD, even though nowadays the USD is also not as strong, maybe also against fiat currencies, and maybe that's where Bitcoin comes in, but still have some element of diversification. Even if you're investing in the USD money market fund, that's actually even worse, not better, because a USD money market fund can only give you maybe 3, 4, 5% per annum. But then again, other asset classes like investing, for example, the S&P 500 can give you 11%. So even though it is protecting you from currency risk, that's a USD money market fund, it's still not giving you a very decent return in the long run. So your money is not growing at all, because you're only getting 4% per annum in a USD money market fund. Well, the inflation maybe in the US is maybe at 2% or maybe 1 point something percent, of which you are only beating inflation by a very small margin. And you could be doing way better by diversifying your portfolio, by even maybe adding a simple asset class like maybe an index fund or maybe an ETF that tracks the S&P 500. Then the last thing about money market funds, maybe the last disadvantage about money market fund, is that money market funds usually are near cash instruments. So you have ease of access to accessing your money in a money market fund. That can be both advantageous or disadvantageous, because depending with how you look at it. Because there's someone who will have the ease of access to their savings, and now they will be in a constant cycle of saving your money. Then after some time, you withdraw all of it, you save again, withdraw all of it. So after 10 years, you'll find yourself that you have been saving and withdrawing your savings. So in the last 10 years, yes, you have saved, but you have also withdrawn all your savings. So now you have nothing to show for the last 10 years, which that is not a so good thing, because over time you want to be building a portfolio. So let's say, for example, you're just getting started with your financial journey. So maybe today you are worth, let's say, just maybe 50,000 that you have in your bank account. You should have targets of maybe in the next 10 years to have a portfolio of, let's say, 1 million, or 5 million, or 10 million, or 100 million, whatever your goal is, depending on the level of income, the amount that you have right now, and your level of savings. You should have a goal to grow your money, maybe to compound your money and to build your net worth, or maybe to increase your net worth. So maybe you can achieve financial security, financial freedom, whatever goal you're trying to achieve, you can only achieve it by having a better portfolio, maybe a bigger portfolio as you grow older, or maybe as time moves by. So your money should be growing, and you should not be able to access your money easily at all times, because it can be a disadvantage. So maybe if you're not as serious with your financial journey, you may find yourself withdrawing your money, and it's not maybe a good or a bad thing. It just depends on how organized you are with the finances, because you have a goal of where you want to be in the next maybe 5 or 10 years. So those are the reasons why you should not be using your money market fund for long-term investments. So number one, the interest rates are not as high compared to other asset classes. Number two, a money market fund is not a diversified portfolio. It's not diversified, it's not protecting from all the risks that we have in the economy that investors should be worried about. Number three, it does not give you access to the best growth opportunities. I think I did a video on the best investment options for growth, of which you can check it out. I'm going to be linking it here. But a money market fund does not expose you to the best opportunities for growth. A money market fund, you're only getting maybe a max of 10% in a low interest environment, but maybe stocks can give you even 100%, even 1,000% in a very good time if you maybe know how to pick stocks. Even ETFs can give you maybe 50%, 60%. Other asset classes can give you way higher returns than what money market funds can give you. Then number 4, money market funds are very liquid. You have near-term access to your cash, and that ease of access to your cash can be both an advantage or a disadvantage depending with what kind of an investor you are. So now, after understanding what you can use your money market fund for and what you shouldn't be using your money market fund for, I want us to also understand some of the key things that most investors don't understand about money market funds. Before we look at the last set of things that most investors get wrong about money market funds, I would like to answer one of the questions that I get asked often, which is, yes, I don't recommend money market funds for long-term investments. So what should people be using for long-term investments? So the answer to that is that you should be trying to build a well-diversified portfolio for long-term growth. So whatever asset classes that you want to put in your portfolio, that's for you to decide. Maybe you can sit down with a financial advisor, maybe you can sit down with me, you can book a session with me, and you can discuss that. But whatever asset class that you want to look at, maybe to invest in, so you can list them down, whether it's real estate, whether it's bonds, whether it's the stock market, whether it's offshore stocks and ETFs, whether it's special funds, whether it's Bitcoin, whether it's gold. So you should list the asset class that you want to add in your portfolio and the allocation, and then try to build a well-balanced portfolio that can help you achieve your long-term financial goals for the long term. So you can always now be putting more money into this portfolio and trying to optimize it for growth, or maybe for passive income, or whatever goal you want to optimize it for in the long term based on your financial goals. So don't use your money market fund for long-term investment. Try to build a well-balanced portfolio, maybe a well-diversified portfolio that can help you achieve your financial goals for the long term. So now that you have pushed that out of the way, now let us look at some of the other things that maybe investors get wrong about money market funds. So number 1, there are people who try to argue that T-bills can outperform money market funds, or maybe that rather than putting your money in a money market fund, because maybe a money market fund invests in treasury bills, why can I not put my money in a T-bill directly and maybe save myself the management fees that money market funds charge? So those are people who are trying to maybe think of how they can register a superior return. But I want to assure them that the battle between a money market fund versus a T-bill, we don't know who the clear winner can be at any particular moment in time, because it depends on a lot of things. So, but in most cases, out of the simulations that I've done, most cases a money market fund will beat a T-bill, but even in some cases, a T-bill can still beat a money market fund. So let me try to explain that. So number 1, a money market fund compounds your money month on month, or maybe daily. So your money is compounded daily, but the interest is added to your account at the end of every month. So that's how most money market funds operate. So the daily compounding of a money market fund can be very advantageous compared to a T-bill that earns your money by simple discounting. In a T-bill, you just get the discounting that maybe if you want to maybe invest 100,000, you're going to maybe pay 97,000, and then at the end of the period, you get your 100,000 back. So that discounting is not compounding, but for a money market fund, your money is compounding daily, and the interest is added to your money market fund at the end of the month. So that compounding can work quite well for a money market fund. Then again, if interest rates are rising, so let's say for example, we're in a period whereby interest rates are rising from a low interest rate environment to high interest rate environment. So you know, money market fund is changing or be adjusting the rates on a day-to-day basis based on market performance. So the interest rate will be going upwards. So that means your money will also be getting that daily change in the interest rate that your money is growing at. But now in a T-bill, if let's say for example you buy a 365-day T-bill, you have already fixed that rate. So if let's say for example today the interest rate for the 365-day T-bill is maybe 9%, and then 1 year later we are at 12%, like we had seen the high interest rate environment last year. So that means your T-bill will still be locked at 9%, while us who are investing in money market funds have seen that change and have experienced the increase in rates for that time. In a period whereby you are moving from a low interest rate environment to high interest rate environment, most money market funds can outperform the T-bills. But the reverse is also true. So whenever you're moving from a high interest rate environment to a low interest rate environment, so the T-bills can outperform money market fund because you can lock a high return in a T-bill. For example, the guys who bought T-bills at 16%, or maybe 16% when the T-bill rates had hit their record highs at 16%. So they locked in that return of 16%. So now when money market funds are at maybe 11% or maybe 12%, they had locked in that high return of 16%. So just to sum it up, it's not always clear who between a money market fund and a T-bill will carry the day, because even whenever fund managers, maybe whenever these money market funds are investing in T-bills, most of them, or maybe in T-bonds or fixed deposits, most of them bid competitively. So what these guys can get, for example, with a fixed deposit or a call deposit, remember, they're investing millions and billions of money, so they have their bargaining power, so they can negotiate for better rates with banks. And like maybe you and I, who are only maybe investing a few thousands or maybe a few millions of our money in these places, so they can get maybe better rates for T-bills, better rates for T-bonds, better rates for call and demand deposits. And like you yourself, who is only investing a little amount of money, who can't maybe doesn't have the financial muscle to negotiate those rates. So even before you factor in the management fees, these guys have already outperformed you because they are able to get higher rates for those asset classes. There's no clear winner, but for me, I usually say there's no need of investing in a T-bill because you are getting the same access in a money market fund. So maybe you can use T-bonds, but not T-bills because the two are different. So the people don't understand that. T-bills are the short-term government securities. So between 3 months to 12 months, you usually have the 91-day T-bill, the 182-day T-bill, and the 364-day T-bill. So they are the long-term government debt. So I don't see the need of investing in that. You can just use your money market fund. But for the long-term T-bonds, anywhere between 2 to 30 years, those ones are okay. But for short-term, just use your money market fund because number one, you don't have to raise the minimum amount of 50,000 or 100,000 for T-bills. You can just invest anything that you want in a money market fund. For money market funds, you don't have to bid, wait for the auction results, talk to your bank to deposit the money, all that hassle. You can simply just open your money market fund account, and anytime, regardless of how much you want to top up, you can always top up. So money market funds are much easier and more convenient, unlike the T-bills. So for your short-term investments, just use a money market fund. Then the last thing that I would like to address about money market funds is all about which money market fund is the best. Maybe there are guys who are usually obsessed with the returns of money market funds. So remember, returns of money market funds are changing day in, day out. So the obsession of maybe which money market fund is giving you the high return, which one is giving you the low return, and jumping out from one money market fund to the other, it makes hardly any sense because at the end of the day, most of these money market funds are going to aggregate at almost the same level, maybe at the same range of interest. And then again, like I mentioned, money market funds is not where you're going to win this game. So don't obsess on which money market fund is giving you the best interest rate, because that's not a very good way of trying to optimize for your portfolio. Maybe you can try to diversify your portfolio into other better assets, maybe like stocks. If you're trying to ask yourself which stock will give you the better return, maybe which ETF will give you the better return, maybe trying to invest in maybe a Bitcoin to try to outperform other people. That's a better strategy for you trying to outperform other people, maybe other investors or the market, but not trying to look at which money market fund is the best, because the rates are changing every day. And whatever money market fund is on top today, probably won't be on top tomorrow. And then again, the money market funds that are fetching you high interest rates, way higher than what the market average is, they may be exposing your money to risks that maybe a money market fund should not be exposing themselves to. And that means sometimes you may lose your money, because you have seen some money market funds, I think like Amana Capital, that was affected some years ago. So some of these money market funds were investing in some things like Euro bonds, fixed deposits with not very strong companies, or maybe corporate bonds, maybe commercial papers with not so strong companies. So it's always important to check the fund fact sheet of your money market fund to understand where they're investing your money, not just being amazed by the returns. Then the other question I usually get is which money market fund is the best. So for me, I usually recommend the largest asset management companies in Kenya. So that's CIC and Sanlam. And like I always mention, if you'd like to open a money market fund with any of those fund managers, you can use the link in my description just to open your money market fund. So I usually try to use them because they are the most stable ones, and they are big enough, and they have been in the game for quite some time. So even though they may not have the highest of rates, like I mentioned, I think they have been in the industry for the longest, and the many investors have invested in them, and the huge amounts that they have in asset management, it's enough proof that these guys are trusted and proven. So I usually prefer the money market funds with the largest market share, because I want to have the confidence that my savings are in a good place. So don't obsess over the rates, don't obsess over which money market fund is the best. So just understand the simple role of a money market fund is just to give you an interest rate better than inflation. If you want to achieve financial freedom, if you want to invest for the long term, if you want alpha returns, above average market returns, the money market fund is not where you're going to get the difference. Please explore other asset classes. So that's it on this video about money market funds. If you enjoyed this video, please give me a like, share this video with a friend, and consider subscribing to my channel, as I'll be releasing more interesting videos. And if you like financial content, you can always go back to my profile and watch many other videos that will help improve your financial literacy. So that's it on this one. See you in the next one.